Good afternoon, and thanks for joining us on the afternoon update on Money FM 89.3. This afternoon, we finally come to the end of the work week, guys. I don't know about you, but what a week it has been. It's great to be joining you again on Facebook, YouTube, and LinkedIn. I love our weekly catch ups at the end of the week. And to all of you joining us on the radio as well, don't forget you can text me. I've got my phone right here, 8855 0893. We've got a great hour lined up for you. We're going to be joined in just a bit by Nicholas Mark, who is the head of research and consultancy at ERA Real Estate. He's going to talk to us about HDB. They're launching 9,500 new flats next week. He's also going to be talking to us about some of the developments that we've seen on the SIRS front that's just come out in the news. I think it was late last night. We've been reading it on the news over the last few hours as well. Not forgetting what's going to be happening in the next few months when it comes to property. We did see that property numbers slumped since I think April 2020, the lowest since April 2020. What does that mean for the next few months? Are the cooling measures finally kicking in? Nick is going to tell us all about that. Of course, we'll be joined by our friend Jeff Howie, market strategist at the SGX in the 3 o'clock hour to break down all the latest market moves and news. But first, let's welcome Nick to the show. Nick, thanks so much for joining us today.
Yes. Well, it's always a pleasure to talk to you, Rachel.
Good to have you with us, Nick. It's been a while since we got on the show.
Yes. Always glad to be back.
Good. I think good that Echo is gone as well. So, Nick, let's get down to the details of what's been happening in the property market. We've just seen some news come out, and that's that a petition for the selective en bloc redevelopment scheme to put on hold and thoroughly review has been turned down, as it does not expect many more sites to be eligible for the highly selective scheme. We're talking about SIRS. So the Ministry of National Development, in a written response to Parliament, they've said that the petition, handling the petition, they said that most of the projects with high development potential have already been selected, and thus an extensive review of SIRS would be unnecessary. Nick, what are your thoughts?
Well, I think that government has been fairly reasonable in that they try to accommodate as much as they can for the whole affected home buyers for the SIRS. Whether or not, well, in the government's opinion, the location of the replacement flats is actually not inferior. Yes, it may be slightly further from the Ang Mo Kio MRT stations, but there are also other amenities nearby. It's further away from the Central Expressway, which can be a very noisy and dusty expressway. And the other thing is that the government also comes up with a new scheme, which is that affected residents, those who are eligible, can actually buy the replacement flat at the shorter lease of 50 years, which is something that's new, something that was not offered to other residents or previous SIRS schemes. So the government is also not able to bend a bit too much backwards just because people take to social medias and talk to the reporters, so on. Because bear in mind, there will be going forward, there will be other projects, other HDB flats that will either be acquired by the government through the selective en bloc redevelopment schemes, or further down the road, the voluntary en bloc redevelopment schemes. So the government has to strike a balance between making things a bit more, making things slightly more generous to the residents, but they must also be a bit fair, because the residents are actually exchanging a much older flat that only left 57 years on the lease for a flat that's brand new. So there will be, some of them will be required to top up some money.
And let's not forget that for some flats, SIRS won't be available as well.
Yes, I think for that, for some of them, if the owners are really, the affected owners are not happy with the replacement flat, they can always select the options of taking the money and buying a replacement flat. Or to move in with maybe their adult children and so on. So there are other options available to the affected owners.
Okay, Nick, let's talk now about on the topic of public housing. HDB, they're going to launch
Mm.
9,500 units next week. Can you tell us more about what's being launched and where?
Okay, well, I think that in the upcoming BTO exercise, which should be the last one for this year, the
Mhm.
numbers is quite huge, 9,000 over HDB flats, and they are also located through a few locations, including some new locations, such as at Ulu Pandang, at the more western sides, and at Ghim Moy. So about three of the projects will be PLH or prime location housing model uh, s- projects. So these are located actually very near to MRT stations. Their price will also be a bit higher. But for those who do not want to, or the PLH projects, they can. There are a lot of other projects that will be offered, including some that is in the non-mature estates that might be also more affordable. But well, we'll all get all the details in less than a week from now.
I want to move now from public to private. And we saw Singapore home sales slump to lowest since April 2020. Is this a sign that property curbs are finally kicking in?
Well, it's interesting that the property curbs was introduced at the end of September, and the
Mm.
next month in October, many primary school children and secondary school students are having their exams. So some parents are actually not interested in housing. They are very busy helping their children to revise, and also, of course, driving the students, their children, to make sure they are on time for the exam. So during the exam period, sometimes the property market can be a bit more quiet. Developers are also and also other market participants are also gearing up for the year-end festivities. Christmas is coming, and also shortly after that, it will be the Chinese New Year. Another reason for the slight slowdown is also that developers are also a bit running out of big projects to launch. There's one big project, which is an executive condominium, Copen Grand, that was launched in October. But other than that, some developers are saving their bigger projects to be launched next year. So the year-end period typically is a slower period for the property market in terms of sales. And so the slowdown in October is something that we anticipated because it's a combination of the effects of the cooling measures, where this time around, the cooling measures is a bit more complicated than previous rounds, which basically is increase in the additional buyer stamp duty. This time around, there is more to do with total debt servicing ratio. There is the interest rate floor that's affected. So home buyers will need to take a step back to re-examine their financial situation, talk to bankers and so on before they make the next move. So that also contribute to more delays and re-examinations before home buyers are ready to commit. They have to work out what is their new housing budgets.
And that said, Nick, I mean, just on that, in terms of balancing financials, this week we saw mortgage interest rates hit 4.5%, I think was the highest. What does this mean for property buyers? Could this also
Well,
mean that we could see property transactions cool down even further?
Well, I think that we can expect property transactions probably to remain a bit on the low side for the November and December. They'll start to pick up in January, but they'll again slow down when we approach the end of January because of Chinese New Year. Well, even
Mhm.
property agents and developers would like to take a break as well. So for the rising home loan rates, well, there's a few things that, yes, it could lead to higher monthly mortgage payment for borrowers. But there's a few things that borrowers can do. One of them is to examine whether or not they are currently on the fixed rate
Mhm.
or floating rate or variable rate package. If let's say they are on the fixed rate package and their interest rate that they are paying is lower than the prevailing market rate, and they still have a year or more to go, then they're in the happy situation. Just sit tight. Now, if they are on the variable interest rates and their interest rates that they're paying now is higher than, let's say, some other promotional packages out there, then it's worthwhile to do some shopping around, to do some comparison to see whether or not they want to refinance without any financial penalty. Now, if a borrower is paying a very high interest rate now and he has some spare cash or savings, it does make sense to pay down his loan, starting with the loans that actually attracts higher interest rates, such as credit cards or overdraft loans. And then if he still has something spare, pay down his home mortgage, so that with a smaller principal, he will be paying lower interest payments. Now, there are also ways that the home buyer can perhaps look to monetize his property, such as if he has a spare room, he might want to rent it out, he might want to consider renting out so that he can earn some rental income. If that borrower is facing some cash flow problems, he might want to talk to his banker to see whether he can restructure his home loans, such as lengthening the loan tenure so that his monthly installments can remain the same or even lower. But there is no free lunch in finance. If he were to lengthen his home loan, it would mean that over the whole duration of the loan, he could be paying overall higher interest payments. So just bear in mind, there could be a sting at the end.
And I love that, no free lunch in finance. And it's interesting that you mentioned, Nick, that you can negotiate the tenure of your loan, because that is something that a lot of homeowners don't actually know. I actually did that in 2020 and I locked in quite a tasty rate until 2025. But that was because we were able to negotiate the tenure of our mortgage.
Yes, I think, okay, it also depends on whether the borrower is in the lock-in period, because sometimes
Mhm.
at the start of the loan tenure, the banks might lock in. Like, for example, the borrower will not be able to make any adjustments. But if you are already free of the lock-in period, yes, you can renegotiate that. But on the whole, if interest rate is actually very high, it does make sense to consider how you could reduce the principal so that overall you will be paying less interest.
That's right. Nick, one last question for you before we let you go. Time has just flown by. Tell us, as we come to the end of 2022, what are some of the key trends that you're going to be looking out for in the property sector as we head into 2023?
No, I think that with the cooling measures, in fact, we had 2 rounds of cooling measures in the past 11 months. In the background, the property market prices, I think is now bearing in mind if we don't have, we still have steady economic growth and not suffering economic recession, there will still be upwards pressure on property prices and also property rentals. Come a bit to that. So property prices likely to rise, partly because of there is still healthy demand, and also there will be other forces that's going to pull the property market in opposite direction. But on the whole, the property market is going to be affected by macroeconomic factors such as GDP growth, the job market, changes in household income, interest rates, and inflation. And some of the factors that's going to be affecting both the prices and rentals is actually the supply that is out there. Currently, the amount of supply that developers have to sell on the open market, it has actually fallen from about a year ago. There was about 12,600 private housing units that developers could launch and sell. Right now, that number has fallen to about 5,300 units in available supply. So the amount of supply has fallen. Development cost has risen in line with inflation, and due to inflation, and as a result, developers are facing upwards cost pressure, so they won't be able, and they may not have the incentive also to lower prices. On the rental front, we see that there's actually not a great deal of relief, unfortunately, in the HDB rental market, partly because the number of HDB flats that reached the end of the 5-year MOP period, we reached a record number of 30,200 flats this year. Next year, that number is going to halve to about 15,000 HDB flats. In other words, the number of HDB flats that's eligible for either to be sold on the resale market or to be rented out will fall next year. But in the private housing market, provided that the construction industry, the pace of construction is able to continue or even speed up, we will see more condominiums that will be completed next year, perhaps somewhere around the 15,000 to 18,000. So there could be some relief in the rental market next year, probably towards the second half of next year.
Good news there for HongBin. Nick, thanks so much for taking the time to speak with us today. It's always a pleasure to have you on the show.
Well,
We've been
the
speaking
feeling's
with
mutual.
Nicholas Mark, Head of Research and Consultancy at ERA Real Estate, about all the property trends that you need to know about as we come to the end of the year and looking into 2023. We're going to take a short break now from social media for the news. We'll be back with you with an interview with Jeff Howie, market strategist at the SGXX, coming up at 3:05. So keep it here on Money FM 89.3. Thanks for staying with us here on the afternoon update on Money FM 89.3. I'm Rachel Kelly and I'm joined in the studio, of course, by Hongbin Jeong.
Hello.
Hongbin, have you got any fun plans for this weekend? Don't say laundry. You're not allowed to say laundry. The word is now vetoed on a Friday.
I'm getting my aircon cleaned. I feel like I mentioned this 4 weeks ago, but I don't know if I mentioned it on the show. But my aircon guy has consistently kept canceling on me, and I still haven't gotten my aircon cleaned.
I think it might be a sign that maybe you need to make other weekend plans.
Maybe.
Okay, well, I've got an idea, some inspiration for you. Perhaps you
Okay.
need to book another trip. Okay, so I picked this article up on CNN, and this is a giant floating city that could become the world's largest boat. And I just want to show this to you, Hongbin. You're going to have to help me and let me know if I'm getting the angle right. Can you see this?
Yes. Yes.
Okay, so this looks like a giant turtle. This is, in fact, a giant floating city, and if built, it will be the largest floating structure ever constructed. Now, it's called Pangeos, named after Pangaea, a subcontinent that existed from 200 million to 335 million years ago. And if those seem like big numbers, just wait until you hear how much it's going to cost should it be constructed. Okay, do you want to take a guess?
I don't know. A billion dollars?
Try $8 billion.
Oh my
$8 billion. So go and check this out. It's really interesting, though, the concept behind it and how it's going to be constructed. So this is Pangeos. It's going to cost $8 billion. I feel it looks more like a Bond villain lair than anything else. It's going to sprawl 550 meters. It's going to be 610 meters wide. Would you like to sail into the weekend on Pangeos? Let us know. Text us 88550893. Okay, coming up next, we're going to check in on the markets with Jeff Howie. He's waiting on the line.
Good afternoon.
Hi, Jeff. How are you doing? Good to have you back with us this Friday.
Thanks, Rachel. Good to be here. Thank you.
Having a good week so far?
Yep. Very good. Very good. Very busy, as you have been as well.
Yes, it's been a busy week. And let's take a look at where Singapore shares are as we come to the last 2 hours of trade. The STI in the red, down about 0.5% at 3,271 points. Advanced still leading the pack, though, decliners leading the pack now, 272 to 240 advancers. In terms of volume, we're looking at about 859.5 million securities worth $789 million that changed hands so far. What a week it has been. We've had NODX numbers, not to mention all the high-level discussions that have been taking place this week. Jeff, what have been your highs and your lows for the week?
I think you just named them, but I guess the STI, it's up 1.3% so far this week. It's trading at around 3,270. So as you said, while it's down today, some of that momentum that we've seen in recent weeks has carried through. So the STI, we saw it test that 3,300 level yesterday, and then again this morning. And that's a key threshold that provided some level of resistance for the STI back on the 13th of September, and before then on the 11th of August. So that's the 3,300 psychological level per se that was tested. In the data and the policy front, it has also been relatively quieter. I guess that explains why the STI gained 1.3% compared to the previous week, which was a 3.1% gain, and the week before that was actually a 2.4% gain. So STI still performed fairly well when you consider ASEAN indices are generally flat across the board this week, or on an average basis, and China is as well. However, the Hang Seng Index is up around 4%, and that's really put down to the fact that internet stocks have pretty much led the global stock market this week. So, as we said, I guess a little bit less momentum than we've seen in the recent weeks. A little bit of a quieter week. Nonetheless, some good turnover as the market has consolidated on these recent gains.
Oh, Jeff, who are the biggest movers this week? I feel like today we have VC Plus. It's up around 80%, but at one point it was up 100%.
Sorry, what was that one, Hongbin? Which one?
VC Plus.
Okay, yeah, I'll go and check that out. um, I don't think it has that much impact on the STI though. But the STI, as you know, it's the 30 stocks, and the banks make up 45% of it. So in terms of which stocks had the most impact on the STI, the trio actually saw some pretty symmetrical gains of 2 to 2.5%, and that's what had a big impact on the STI. In terms of the different constituents, the best performer for the week within the STI was Mapletree Pan Asia Commercial Trust, and then on the other side, Hong Kong Land Holdings was the least performer. Outside of the STI, though, as you say, that can be pretty interesting territory. UMS Holdings, which is typically a top 50 stock by trading turnover, it has rallied 12% this week. After the Friday close last week, it reported its best ever 9-month financial performance, and its share price has, as we said, it's moved from $1.07 to $1.20 at the moment, and that brings its stock price gain since the STI made that recent low just before the Diwali holiday. So going back to the 21st of October to now, UMS has actually rallied 39%, and that's paired its year-to-date decline to a decline of 18%. And one more important thing, or one more important aspect, I think, for our market outside the STI is the palm oil plantations, because we have our three most traded trio of Golden Agri Resources, First Resources, and Bumi-Tama Agri. And that trio of stock, they all reported their third quarter results on Monday, and they have averaged 6% returns this week. The trio have all benefited from higher average selling prices of crude palm oil. And for their third quarters, I think Golden Agri Resources revenue was up 9% year on year. First Resources revenue was up 15% year on year. And Bumi-Tama Agri's revenue was up 21%. Now, Golden Agri noted that palm oil continues to be priced at a discount relative to other vegetable oils, and those other vegetable oils are, of course, facing supply chain disruptions. First Resources relayed also that the palm oil's attractive pricing relative to other competing edible oils has been also encouraging replenishment of inventories from the importing countries. And then also on the supply front, Bumi-Tama Agri noted that extremely rare, the triple deep La Nina weather phenomena is expected to last going into next year.
Jeff, I just want to pick up on Hong Kong Land. I was just taking a look at the SGX website. Hong Kong Land currently down around 5.2% today. What's driving that?
Yeah, Rachel, I don't actually know what has been driving it. I mean, there haven't been any corporate announcements since the interim management statement on the 10th of November, and no dividend fronts as well. So can't actually answer that one for you. Sorry.
Okay, well, I've got another one for you that maybe you can answer for me. So my stock pick of the week last week to watch this week was Singtel. They were doing pretty well. I mean, earnings were out last week, not looking too shabby. Plus, they announced a pretty sizable dividend as well. But taking a look at Singtel today, they're currently down over 3.5%. Why?
Yeah, I can actually answer that one.
Okay, thanks, Jeff.
Yeah, so it's still gained 2.6% this week. It has still seen the most net fund inflows so far this week, and it also has led the share buyback rally this week, buying I think 3.4 million shares on Wednesday and Thursday together. So I think they bought them at an average price of $2.78. Now, why today it's off is because the stock has gone ex-dividend today. So there was an interim dividend, and that special dividend as well, the first tier of that special dividend. So those two dividends added up to 7.1 cents. So that explains much of that share price decline today, Rachel.
A little bit of profit taking as well there.
Yeah.
Okay.
Well, I chose Genting Singapore last week. It's unchanged today, but it did rise about 0.02 cents. or 2 cents.
Yeah,
Sorry.
and it's just outpaced Singtel for the week as well. It's up 3%
Mm,
for the week, and it's while Singtel saw the highest fund inflows,
Mhm.
Gunting has seen the seventh highest net fund inflows so far this week, and it also means that with those with that gain this week, Gunting is now down just 0.6% in total
mhm.
return since the end of 2019.
Okay, so I want to take, before we go into our stock picks for this week, I want to just take a look at sectors and let's just
Yep.
talk a little bit about S-REITs because they mostly reported top line growth for the third quarter, but higher interest rate and currency headwinds have also taken a chunk out of their distributable income to unit holders. And Hong Bin popped this question in as well, and she wanted to know what can we expect moving forward on the REIT front.
Yeah, look, the REIT market has been very fast moving this year.
Hmm.
So you've got the higher interest rates and the currency headwinds, seeing the FTSE ST REIT index a few weeks, about a month ago, it extended its discount to book value to 16% back on that 21st of October, just before that Deepavali holiday. The IHS REIT index extended its discount to book value by 18%. And since then, however, the two REIT indices have seen those discounts narrow somewhat. So it's only 8% for the FTSE ST REIT index and 10% for the IHS REIT index. Now, by comparison, both those indices were trading at a 10% premium to their book value a year ago. So what's happened is since that October 21st session that saw the STI make its most recent low around 29.70, we had that a month ago. We had this very quick three-session rally that was earnings based, and it was a three-session rally in the S&P 500 with it gaining 5% in three sessions, and that ignited this recent move up, which has taken the STI all the way back to 3,300. The October 21st session, as we said, since then, the S-REIT sector has even marginally outpaced the STI gains. So the
Mm,
FTSE ST REIT index has generated 11% total return since then, and that's
yeah.
almost twice the return of the FTSE EPRA REIT index. That 4-week period has seen CDL Hospitalities Trust, Capital Land Integrated Commercial Trust, Daiwa House Logistics Trust, Mapletree Logistics Trust, and Keppel DC REIT actually lead the S-REIT gains. Now, business updates definitely have impacts, but when only pretty much when they come in markedly different from expectations, because as you said, the REITs are moving with the economic drivers that also determine the financials for the REITs. But importantly, they can also be subject to the, as you mentioned, these rate and these currency headwinds. Not to mention, there's that key global market that competes for the demand for yield, the US Treasuries, 10-year US Treasuries. So the 4 past weeks have seen the US 10-year yields decline 50 basis points from near
Mm,
4.3% back on 21st of October to the 3.7% range at the moment. US dollar index has also retreated from 114 back on the 21st of October to 106 at the present level. So that has seen REITs outperform globally over the past 4 weeks. But looking forward, because this market is so dynamic, what's priced in for now is a Fed funds peak or terminal rate now seen at 475 basis points to 500 basis points. So the peak rate will is expected to go up to 5% from March next year through to October next year. And there's expected to be an 85% chance for a 50 basis point hike at the 14th of December. So that is a key. That's setting the stage for where the REIT
mhm.
market is at the moment. Any major deviations that come from that, with the Fed speak next week or the FOMC minutes, can now obviously have that impact on the REIT market. But there's also just one more little thing,
Mhm.
plenty of sub themes as well when it comes to the REIT sector. I have to mention that. There's plenty of sub themes. The REIT Watch column, for instance, that my two colleagues, Candice and Amelia, put together, do hone in on a lot of those sub themes on a weekly basis in the Business Times. And I think this Monday, Amelia will be looking at the Hospitality Staple Trust and how they've been riding this
Right.
pent up demand travel. Yeah.
Moving away from REITs now, Jeff, I want to ask you about this logistics firm, Legend Logistics. And according to people familiar with the matter, they're exploring an initial public offering in Singapore. What can we expect?
Yeah, Hongbin, I can't discuss that because
Mhm.
the potential IPOs we
Mhm.
can't discuss because it is confidential until any prospectus of the IPO is actually lodged on the MAS Opera public portal. So once any, I mean, there could be a number of IPOs, and I'm sure there's a number of issuers that our equity capital markets teams are talking with. And then when we can talk about anything that does develop, it can only be after the entire public can access that information on the public portal that the MAS have.
That's right. Thanks, Jeff. So, Jeff, I just want to go back to some of the highlights of the week and just very quickly, let's talk about those surprise 5.6% fall in Singapore exports for
Yeah.
October. I mean, headlines said it was a surprise. Were you surprised though?
No, not at all. That was expected. So 17th of the month is always our NODX day,
Mhm.
and look, the overall trade was okay because of oil. So
Yeah.
oil I think really put up the numbers. But what weighed NODX were three things. First, there was a very high base in October 2021. That high base will continue throughout to the end of the year. Number two, there was the continuation of the weaker demand from China. And number three, there's also the year-on-year decline in electronic exports, and that was for a
Mhm.
third consecutive month. Now, the weaker demand from China, it has persisted since July. We've had year-on-year declines in the vicinity of 30% to China in October and September, and those year-on-year declines were in the vicinity of 20% for both August and July. And then the electronic exports, they continue to be weighed, of course, by integrated circuits and disk media products. So do note, however, that the electronic domestic exports did grow in October from September. And like the REITs, as these markets, these stocks are very dynamic, moving to these fluid
Mhm.
data releases. So that's kind of paralleled as well. Similar recent moves we've seen in our technology stocks. And really, the outlook for global trade, it is for further deceleration next year. I think down to 2.7% global trade growth expected from 3.2% this year. This is on a global basis. However, like the recent moves in the stock market, the global trade, it really does hinge a lot on the outlook for China growth. And the outlook for China growth, it has been helped in recent weeks. That you've had a slate of policy moves, the optimized COVID rules to bolster their economy. You've got fiscal support to small businesses. And in addition to these supportive property market policies that have reportedly been introduced, which of course include those 16 measures co-released by PBOC and CBIRC. So that has seen also five of the biggest primary listed Singapore stocks by market value that do report at least half their revenue to China move with those policy developments, with Wilmar, Yangtze Jiang Shipbuilding, Hutchison Port Holdings Trust,
Mhm.
Yandord Land and Capital Land Trust, averaging around 9% returns in the November month to date.
Okay, Jeff, before we run out of time, because there's so much to talk about, and we haven't even gotten into the G20 and everything that's happening on the macro economics scale yet. There's just so much happening this week, as there seems to be with every week when it comes to our conversation at the end of the week. But let's get down to our stock picks for the week. So mine was more on the back of I'm interested to look more into the medtech sector here in Singapore. So maybe we can talk about the sector overall. And I've kind of switched who I want to watch this week and to read up a little bit more about. And this was hotly discussed during the pandemic. I'm talking about Top Glove. We haven't spoken about them on the show for a while, but I just want to keep an eye on what's happening with Top Glove and also to take a deeper look into what's happening when it comes to health tech or health plays on the SGX.
Yeah, it makes sense. That it's also Top Glove, Riverstone, UG Healthcare.
Mm-hmm.
They have been on the move somewhat since
Yeah.
since the 21st of October as well, and Top Glove has led them. Top Glove's actually rallied 33% in the last 4 weeks, so the stock is it can definitely be a mover, but nonetheless it is flat this more
Mm-hmm.
put in a more flat performance this week, but a very important component of our stock market. Rachel. And as you might have seen, we've got global COVID cases as well, marching a little bit higher. Yeah, the smooth daily average was down to 320,000 people a day in early November, and since has made a high around 370,000 people a day. So the new strain is seeing more global cases, and that has seen some reaction to those stocks that both manufacture and distribute rubber gloves, whether it's for a health reason or for a tech reason.
And flu season is coming up as well, isn't it?
I don't say that. I just finished 4 weeks of antibiotics yesterday.
Oh no, I know, Jeff. I know. Okay, well, Hong Bin has a different kind of take on her tonic of the week.
Well, sticking to my theme of traveling, tourism, and reopening, I'm gonna choose Thai beverage this week for next week to watch. I mean, I just saw an article today about DBS reinstating coverage for the firm with a buy call, and they say they foresee benefits from the reopening and the strong demand in the region as well.
That's also been our third strongest stock this week, Hong Bin, up 3.3%.
So, Jeff, before you leave us, tell us, what are you watching in the week ahead?
Okay, for Singapore, there's three key data releases. You've got Singapore's final print for the third quarter GDP, 8 o'clock Wednesday morning. It will be revised marginally lower, slightly lower. This is what we're expecting because of the lower industrial production number in September. So I think the advance was 4.4%. So consensus expectations are for 4.3% year-on-year growth. The same day we have our October CPI inflation number. It was, remember, 7.5% year-on-year growth in September, expected to be around 7% year-on-year for October. Core inflation expected to stay at 5.3% year-on-year as it was in September. And then you've got October industrial production data, which will be released on Friday. The consensus estimates are for a 2% year-on-year decline, but note that UOB actually estimate it might come in at a 0.4% increase. FOMC minutes for the last Fed meeting will also be released next week. You have 3 FOMC voters speaking as well next week. The Fed speak is super important, as we've seen. The Fed have this premise that inflation expectations do create inflation, somewhat like a self-fulfilling prophecy, which means given that October deceleration we saw in the US CPI, it's likely that Fed Reserve will feel vindicated and keep up the hawkish mantra. There might be rare dovish concessions like we saw this week with the Fed Governor Waller, who said, yep, he might be open for a 50 basis point hike, but that's nothing new. Markets are at 85% expectations for a 50 basis point hike ever since their lower CPI number came through.
Okay, Jeff. Well, thank you so much for taking the time to speak with us again this Friday.
Thank you.
Thanks, Hong Bin. Thank you so much, Rachel. Have a great weekend.
Have a wonderful weekend. We've been speaking with Jeff Howie, market strategist at the SGX, to break down all the biggest market moves and news for you right here on Money FM 89.3. Thank you so much for joining us on social media, Facebook, YouTube, and LinkedIn. Hello to everyone that has joined us to watch what we're getting up to in the studio today. Actually, we're broadcasting from the lobby studio, which is why you see a bit of a different background and surrounding. Hong Bin has a little bit of greenery all around her. We'll be back up on the 3rd floor next week, but wishing you all a wonderful weekend. We've got another 30 minutes left of the show on Money FM 89.3, and of course prime time's coming up next at 4 p.m. So keep it here on Money FM 89.3. We are Singapore's most influential radio station. Money FM 89.3. Money FM 89.